Here's something that happens more often than many business owners realize. A lawsuit gets filed against the operating business, and it doesn't just threaten future profits. It reaches every dollar of cash, every truck, every piece of equipment, even the emergency savings you spent 10 years building. That's what almost happened to a client of mine named David. David ran a successful contracting business, good reputation, steady revenue, and over time, he built up nearly $400,000 in retained cash sitting inside the operating LLC. Then a subcontractor injury turned into a lawsuit that exceeded his insurance coverage. Creditors generally pursue assets owned by the company they're suing. And in David's case, everything sat inside that one entity, the operations, the cash reserves, and even equipment he had purchased as an investment. All of it was exposed. That's the problem a holding company structure is designed to solve. Hey there, I'm Tiffany Phillips, CPA and tax strategist. Today, I'm discussing how a holding company strategy works, how it separates risk from your assets, and where it can create real tax advantages if it's structured correctly. Let's start with what a holding company actually is, because a lot of business owners have heard the term without understanding the mechanics. A holding company doesn't operate a business. It doesn't sign customer contracts, hire employees, or generate revenue directly. Its job is to own things. It might own your operating company. It might own real estate. It might hold cash reserves or intellectual property. The operating company is the one doing the actual work, the one with customer risk, employee risk, and day-to-day liability exposure. When you separate those two roles into two different legal entities, you create a wall between them. If the operating company gets sued, that claims exposure is generally limited to that entity's own assets. When properly structured and maintained, the holding company's separately owned assets are generally not directly exposed to claims against the operating company. Let me walk you through how David restructured. We worked with his legal and tax team to create a holding structure that fit the operating company's existing tax classification. Then, through properly documented transactions, certain assets and excess reserves were repositioned outside the day-to-day operating entity. Now, if a lawsuit hits the operating business, it's suing an entity that holds working capital for day-to-day operations, not the reserves David spent years building. Here's the part people can get wrong. A holding company only works as a liability shield if you treat it like a real separate business. That means separate bank accounts, separate books, a formal intercompany agreement if the holding company charges the operating company for anything, and no mixing of funds between entities. If you treat both companies like they're the same business, a court can decide they are the same business. That's what's known as piercing the corporate veil, and it can undo the entire structure. The legal protection isn't automatic. It depends on how the entities actually operate. This is why you don't just form a holding company. You have to carefully design the relationship between the entities. Let's talk about how money actually moves inside this structure, because this is where a lot of business owners get confused. If the operating company needs the cash back that's now sitting in the holding company, say, to buy new equipment or cover a slow season, you don't just transfer it back informally. That undoes the separation you just created. Instead, the holding company can loan money to the operating company under a documented intercompany loan with an actual promissory note, a commercially reasonable interest rate that accounts for the applicable federal rate, and a repayment schedule. And then the payments need to actually be made according to that note. Documentation without real, consistent performance can still be challenged. That interest income is taxable to the holding company, and the interest expense may be deductible to the operating company, but more importantly, it preserves the legal and financial separation between the two entities. This is a detail people skip, and it's exactly the kind of detail that determines whether the structure survives a legal challenge. If money moves between entities without documentation and without real payments, a court can treat the entities as one and the same, which defeats the entire purpose of the structure. Most people tend to think holding companies are only about lawsuits. Not the case. Under the right structure, there can be tax advantages too. Depending on how your entities are set up, a holding company can create a legitimate way to move money between entities without immediately triggering personal tax. If the operating company is structured as a corporation and pays dividends up to a holding company that's also a corporation, the dividend may qualify for a dividends received deduction, often 50%, 65%, or in certain affiliated structures, 100% depending on ownership percentages and other limitations. That means profit can move from the operating business into the holding company for reinvestment or reserves without necessarily flowing all the way through to your personal return first. I want to be clear about something though. This generally applies when both entities are taxed as C corporations. If your operating business is an LLC taxed as a partnership or an S corporation, the holding company relationship still provides liability protection, but the tax mechanics work differently, and you need to look at your specific entity types before assuming this benefit applies to you. There's also a practical benefit around real estate. If the holding company owns the building your operating business works out of, the operating company can pay rent to the holding company. That rent needs to reflect fair market value, just like it would between unrelated parties, and it's generally deductible to the operating business when it does. It also shifts income into an entity that might be taxed differently or that holds the assets separately from operational risk. Let me give you a second example to show how this plays differently based on entity choice. A client named Debbie owns an advertising agency taxed as an S corporation. We didn't recommend converting her structure to a C corporation just to chase the dividends received deduction, because for her income level, the combination of corporate tax and eventual distribution tax made that path less efficient than her current setup. Instead, we used the holding company primarily for liability separation and to hold a commercial property she'd purchased. She separated the property from the operating risk, while the business generally received a deduction for the fair market rent it paid. That's the difference between grabbing a strategy because it sounds good and designing a structure around your actual numbers. Now let's talk about scaling this structure, because a holding company doesn't have to sit above just one business. If you own multiple ventures, say an operating business, a piece of real estate, and a separate side venture, you can structure all three as subsidiaries under one holding company rather than owning each one directly and personally. Debbie eventually added a second small business under her holding company when she launched a separate consulting arm, keeping it walled off from both the agency and the real estate. This matters for two reasons. First, when properly structured and maintained, a subsidiary's liability exposure generally stays contained to that subsidiary, not the others sitting under the same holding company. Second, it centralizes ownership. Instead of your personal name appearing on multiple LLCs and deeds, the holding company owns the subsidiaries and you own the holding company. That centralized ownership also creates a planning opportunity some business owners never consider: estate and succession planning. Instead of transferring ownership of 5 different companies, one at a time with 5 different agreements, licenses, and title work, you may only have to transfer ownership of one holding company. That doesn't mean a holding company automatically solves estate planning. Gifting shares can carry its own valuation and gift tax considerations, and you'd want that reviewed as part of a broader estate strategy. But the structural simplicity, one entity to transfer instead of 5, is a real practical benefit that often gets left out of the liability and tax conversation entirely. Now, here's where I want to slow down, because this strategy isn't right for every business owner, and I'd rather tell you that directly than let you spend money setting up entities you don't need. If your business has very limited liability exposure, minimal assets, and you're a long way from meaningful revenue, the added accounting complexity and formation costs of a holding company may not be worth it yet. You'd be paying for a wall to protect a house that hasn't been built. If you're not disciplined enough to maintain separate books, separate accounts, and proper documentation between entities, the structure won't hold up if it's ever tested, and you're paying for protection that doesn't actually exist. And if most of your liability risk is already well covered by adequate insurance and your assets are modest, a simpler structure might serve you just as well, at least for now. A holding company earns its cost when you have real assets worth protecting, real liability exposure from operations, multiple ventures you want walled off from each other, or a genuine opportunity to shift income between entities in a way that's supported by your entity types. If none of those apply yet, that's fine. It's something to build toward, not something to force. Let's talk about the most common mistakes I see once someone does set one up. The first is treating the holding company as a formality instead of a real entity. No separate accounts, no documentation, with funds moving informally between them. That's the fastest way to lose the protection you built the structure to get. The second mistake is assuming every asset should move into the holding company immediately without checking the tax consequences of the transfer itself. Moving property or equity between entities can sometimes trigger tax consequences depending on how the transfer is structured. So you need this reviewed before you move anything, not after. And I want to flag one mistake that's more serious than the rest. Courts can unwind transfers made to avoid known creditors. Asset protection planning is generally most effective when it is completed for legitimate business reasons well before any specific claim or creditor problem arises. The third mistake is picking the wrong entity type for the holding company without checking how it interacts with your operating company's tax treatment. The dividends received deduction benefit I mentioned earlier only works in specific structures. Set it up wrong, and you get the complexity without the benefit. The fourth is treating intercompany loans as handshake arrangements instead of documented debt with real payments behind it. Skip the note, the rate, or the actual payments, and that loan can be recharacterized entirely, unwinding both the tax treatment and the liability separation you were relying on. If you're a business owner with real assets, employees, or liability exposure, and everything currently sits inside one entity, that's worth a serious look. Not because every business needs a holding company, but because you want to make that decision deliberately based on your numbers instead of by accident, based on how you happened to set things up when you started. Good business owners build profitable companies. Great business owners build protected companies. You work too hard to spend years building wealth only to leave it exposed because of the way your business is structured. If you want me to break down how to actually build a holding company structure step by step, comment HOLDCO and tell me whether your business is currently an LLC, an S corporation, or a C corporation. I hope you found this episode to be useful. If so, please take a second to help more people to keep more by sharing this content. And if you want to best understand how your biggest expense affects your wealth, grab my book, Your Biggest Expense. It's linked in the description. Remember, it's not what you make, it's what you keep. So keep more.